Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into AgEagle Aerial Systems, trading under the ticker UAVS, and recently rebranded as EagleNXT.
And there's a lot to dig into here today for you.
There really is. So to set the stage right out of the gate, EagleNXT is attempting a high-stakes tactical defense pivot, leveraging a unique fixed-wing architectural edge to secure placements on the U.S. Army UAS marketplace. However, this defense thesis is currently obscured by a severe 61.6% collapse in core organic commercial revenues and a hyper-dilutive death spiral financing structure that systematically caps common shareholder returns.
Yeah, and my goal for you today is really just to strip away all the optical illusions of that financial engineering.
Right, because there's a lot of noise.
Exactly. We need to show you the bare metal reality of what it actually takes to compete in the modern military supply chain.
Right.
It's not just about having some cool technology, right?
You actually have to survive long enough to scale it.
Right. Spot on. Because in this sector, a company's capital structure is honestly just as lethal as a competitor's hardware.
For sure. So to understand why a struggling company like this even has a shot at Pentagon contracts, we really must first look at the technology that's, separating them from the pack.
Right, the actual drone.
Yeah, because, look, we know the drone landscape right now is heavily reliant on standard quadcopters from domestic competitors like Skydio and Teal drones.
Sure, those are sort of the industry standard right now.
But standard quadcopters are essentially hovering helicopters. They must constantly fight gravity.
Yep. Physics is undefeated.
Right. So I'm looking at this and thinking, if they are burning all that energy just to stay in the air, how useful are they for long-term observation?
Well, they're really constrained. That's the quadcopter constraint. Because of that gravity fight, they usually max out at like 35 to 40 minutes of endurance.
Which is an incredibly narrow tactical window if you're a soldier.
Oh, absolutely.
Oh.
And on top of that, those four rotors create this loud, high-pitched acoustic whine.
Like an angry swarm of bees.
Right. It's super easy for ground forces to detect. But EagleNXT's eBee vision is totally different. It's a fixed-wing drone.
So it looks more like a traditional airplane.
Exactly. Because it relies on aerodynamic lift rather than just rotors, it completely changes the mission profile.
Wait, how much does it change the flight time?
It delivers over 90 minutes of continuous flight.
Oh, wow. Over double.
Yeah, and a 12-mile deep perimeter range. Plus, once it reaches a couple hundred feet up, it features a near-silent acoustic footprint.
So it's basically invisible and silent. But, great tech isn't always enough. We have to contextualize this within what we're calling the anti-DJI moat.
Right, the geopolitical angle.
Yeah, because bipartisan legislation has effectively blacklisted Chinese drones, specifically DJI, from federal use.
Which is huge. The Pentagon is now terrified of a domestic monopoly. They can't just rely on Skydio for everything.
Right, they need backups.
Exactly. So they are aggressively propping up a diversified pool of U.S. alternatives, and that gives EagleNXT this massive, massive competitive opening.
Okay, let's unpack this, because having the technological edge and the regulatory moat is great on paper. But how is EagleNXT actually getting this hardware into the hands of soldiers?
That is the million-dollar question.
Well, the major operational catalyst here is that the eBee vision is now listed on the newly launched U.S. Army UAS marketplace.
Which is a really big deal for their order flow.
It is. I mean, I sort of look at it as Amazon Prime for the Pentagon. It's a low-friction storefront that allows decentralized military commands to just completely bypass traditional bureaucratic red tape.
Right, you don't have to wait for some general at the Pentagon to sign off on a massive contract.
You can just order it. But let's look at the physical order logs to track this pipeline.
Yeah, let's put some numbers to it. Based on the logs, EagleNXT has sold 34 eBee vision systems across 6 military organizations.
So 34 systems, that's not exactly a massive fleet yet.
No, it's not. What's fascinating here is how these systems are actually being deployed.
Like the ones out in the desert.
Exactly. Let's isolate the 9 kits deployed to the National Training Center. This is for the opposing force, the OPFOR.
Right, for realism training.
Yeah, these soldiers simulate fighting adversary drone swarms. So they're using the eBee vision to harass U.S. troops in training, which is a perfect use case for a long-endurance, silent drone.
And we also saw a follow-on order of 3 kits for the 7th Army Training Command over in Germany.
Right. But we have to be clear here for the listener. These are small-dollar evaluation arrays.
They're testing them out.
Exactly. The true test is whether EagleNXT can convert these 34 testing units into a massive, multi-year program of record.
Right, where it becomes standard issue.
Yeah, until then, it's just evaluation revenue.
Well, here's where it gets really interesting, because with this hardware slowly penetrating the Army, the company is also expanding into the software layer.
The defensive software layer specifically.
Right, the stuff required to defend against enemy drones. We saw this major recent acquisition structure, a $10 million investment to acquire an asset stake in Israel's ThirdEye Systems Ltd.
That's ordinary shares and rights at 9.27 ILS, just to be precise.
Yes, exactly. But wait, I have to push back here. They are burning cash, which we'll get to in a minute. So why sink $10 million into a software joint venture right now? Aren't they biting off more than they can chew?
I mean, on the surface, it definitely looks that way.
Yeah.
But you have to look at the domestic manufacturing synergy.
How so?
Well, EagleNXT now holds a 51% controlling interest in this new ThirdEye USA joint venture.
Okay, so they hold the reins.
Right. And all of this venture is being housed natively inside their newly opened 33,144 square foot manufacturing hub in Allen, Texas.
Oh, the Texas hub.
Exactly. This is the crucial part. This allows them to natively manufacture NDAA-compliant counter-UAS software and hardware architectures right on U.S. soil.
Like the Medusa X and the Chimera UL.
Yep, and the Argus Shield. Because if the Pentagon is going to buy it, it absolutely has to be built here without any Chinese components.
Okay, so the story sounds great on the battlefield, right? And on the manufacturing floor in Texas. But we really need to reconcile this operational promise with the severe reality of their balance sheet.
Yeah, it's time to look at the math.
Because Q1 2026 earnings came out, and it looks like an accounting optical illusion.
That's a great way to put it.
They reported an optical $1.42 million GAAP net income turnaround, so technically a profit.
Technically.
But it reminds me of like finding a rare baseball card in your attic and then going around telling people your salary went up.
That is exactly what this is.
Right. So what does this all actually mean for the health of the business?
Well, let's dissect the math here. That reported profit is a complete mirage.
Unpack that for us.
It was driven entirely by a non-cash $6.48 million unrealized gain on equity securities.
This is their stake in Aerodrome Group Ltd., right?
Yes. Under the accounting rule ASC 321, they have to mark that investment to market. The stock price of Aerodrome went up, so EagleNXT got to claim a massive paper gain.
A paper gain, so no actual cash came in from that.
Not a single dime. If we contrast this paper profit with the grim reality of their core business, it gets ugly.
Very ugly.
They actually had a $5.1 million true loss from operations.
Wow.
And a $2.36 million quarterly operational cash outflow. They're just bleeding money to keep that Texas facility running.
And while they are bleeding money, their core organic commercial revenues, legacy agricultural stuff, saw a brutal 61.6% collapse.
Yeah, that legacy business is essentially evaporating while they try to fund this massive defense pivot.
Which brings us to the really scary part. If we connect this to the bigger picture.
Oh, it's a dilution.
Yeah. We have to forensically expose their $26.91 million ending cash position. Because when you look at how that cash is sustained, it's a dilution death spiral.
It really is a brutal mechanism for retail investors.
They saw a 31.5% single-quarter dilution in outstanding common stock. Almost a third of the company diluted in 3 months.
Right, and that is entirely forced by preferred share conversions, specifically the Series F and G shares.
Orchestrated by Alpha Capital and Stolt.
Exactly. These down-round provisions mean that as the stock price drops, Alpha Capital gets to convert their debt into exponentially more shares of common stock.
Which they just dump on the market, driving the price down further.
Yeah. It systematically caps any common shareholder returns. Every time the company have a little bit of good news, this structure just suppresses the stock.
So, bringing all these threads together to deliver a final verdict for the listener, how do we assess this?
Honestly, you can't look at this as a traditional value investment.
Not with those financials.
No. You have to frame this asset as a highly speculative binary LEAP options contract on domestic defense tech.
A LE-day option. That's a perfect analogy.
Right, because the ultimate question is whether the company can scale its Texas manufacturing fast enough to survive its underlying capital drain.
It's a race against the clock. And for the listener to keep track of this race, we need to outline the 3 primary execution risks.
Let's do it. Risk number 1 is definitely the heavy, front-loaded, fixed overhead costs of operationalizing that new Allen, Texas facility.
Yeah, we're talking about massive rent, capex for the machinery, and unabsorbed labor costs. If they don't get volume, that factory is an anchor.
Exactly. Risk number two is the complete structural collapse of their legacy commercial lines.
Right, it's down to just $1.40 million. They have no safety net left.
None at all. And finally, risk number three, that continuous death spiral dilution profile we just talked about.
Which just systematically caps any near-term upside for retail common equity holders.
It's a massive headwind. And, I want to leave the listener with a final thought to mull over here.
Yeah, go ahead.
If the U.S. military is intentionally relying on these highly volatile, cash-burning microcaps to rapidly build out a diversified domestic supply chain, what actually happens to our national defense readiness if the capital markets just dry up? Right. What happens if these death spirals run their course before these companies can actually scale to profitability?
That is a terrifying thought for the broader industrial base. Well, that wraps up our analysis for today. Risk defined, portfolio protected.